Welcome back to the StockTA podcast. I'm your host, Kevin Stewart. Today we have one of our favorite guests, Chris Temple from the National Investor, and we're going to cover a wide range of topics. I always love his just perspective and point of view on a lot of different things that I don't think you get anywhere else, and he's a great resource for our listeners. So, Chris, welcome back to the show.
Well, thank you, Kevin. Glad to be back.
So Chris and I met at mutual friend John Fennick's commodity conference back in May in Florida, and we just kind of hit it off on a couple different topics. And I just find his insights really valuable and really interesting, not only on the general market, but he's been right on gold. He's been right on the Fed. Like I think a lot of macro perspective that I think as a trader is valuable because you need to understand that if you want to trade in and out of position. So first off, just what are your thoughts on the general market here?
I sent you a cartoon earlier today that my great cartoonist Jerry King did. It's kind of a takeoff of Dr. Strangelove, except Donald Trump is Dr. Strangelove. He's called Dr. Strange Bull. And, the playing off the title of that iconic Cold War movie, How I Learned to Stop Worrying and Embrace the Bubbles. Because every time you think the market's going to correct, we hit new highs. Why isn't anybody's guess? There is a lot of liquidity still out there, and there's a lot of basically, there you go. There's a lot of really bulletproof attitudes out there that people have, and it's odd, Kevin, as you and I were talking off mic. It was only a week ago that the market really threw a fit over the Fed's not the Fed meeting per se. But the press conference that Kevin Warsh did afterward, for which he has come under widespread derision on the part of a lot of monetarists, and people say, wait a minute, we thought we got one Kevin Warsh, but who is this guy? It didn't exactly engender a lot of confidence. And so interest rates spiked higher, the dollar spiked higher, stocks dropped, and all of a sudden, a week later, except for those of us who follow things like this, for the average investor, that's forgotten because the S&P hit a new record.
Yeah, I thought the timing of that was interesting. Then you had the Leopold fund kind of blow up and get bought out. And I kind of thought, here we go. Like this could be like a face ripper to the downside. Like you
Yeah.
start to hit some of those triggers and people can't trade for 10 minutes. And then CNBC loses their mind. And I wasn't, shorting stuff. I wasn't actively like, pulling my hair out. Not that I have much left, but I was watching it and I'm like, this is interesting. I want to watch gold here. Like, I want to see how the market reacts. And then, software stocks come ripping back. Palantir comes ripping back. And it's like, okay, maybe this isn't, all doom and gloom, but it feels like we have a very short memory here. Just a lot of investors and how hedge funds are
It's an
piling
understatement.
in to tech at record pace the last couple of days. I'm like, it's just been really interesting because not a lot macroly has changed. Like oil's down, but the Strait of Hormuz is kind of you wake up in the morning, you flip a coin on what's going to be happening over
Right.
there. So I just think it's been really interesting to that. Then you have the 30-year, like where rates have been and people losing their mind. Like anytime CNBC starts flashing the 10-year, I'm like, this isn't good. So what are your thoughts kind of on yields and interest rates right now? Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
I think we first have to take a step back, Kevin. It was about a year ago, actually over a year ago this past spring. I was at a meeting in New York City, and another of the old newsletter deans, Jay Taylor, and I kind of just an impromptu thing with a few dozen of us after dinner. We ended up this, kind of off the cuff seminar that we were doing, basically on a theme of the end of financial repression. And if you remember to a year ago this last spring, that was when the wheels started to act like they were going to come off in Japan. I mean, Japan has been, not all the time, but the majority of the time for quite a while now, it has been the engine of the global carry trade, where gobs and gobs of cheap yen have been borrowed and invested all over the place in just about everything. And all of a sudden in Japan, the jig is up. They've got the highest official debt to GDP ratio in the world. You can argue, depending on how you figure the numbers, that China is even worse, although China has much more considerable domestic production capacity and assets behind it. Japan was all financialized long before even the US became as financialized as it was. And so here you got the yen starting to crumble. That came to a head recently when all of a sudden, late last week, led by Scott Bessent, the Treasury Secretary, there was a major effort, first concerted effort since the late 90s and the Asian financial crisis, where the Treasury had to get directly involved and now trying to drag the Fed into it to help shore up the yen so that the whole carry trade doesn't go kablooey and people in Japan and other holders of yen end up having to start wholesale selling everything to make themselves whole. So the whole world financial structure is a lot more rickety than the average person realizes. And when I was on with you the last time, Kevin, you and I talked about a lot of the unfinished business really from 2008
Yep.
in our country. You mentioned Leopold funds. I mean, everybody from Goldman Sachs on down has had redemption issues. They've had to freeze redemptions and certain kinds of funds tied to private equity, tied to commercial real estate, mortgages especially. So seemingly, at least where the Treasury is concerned, more smoke and mirrors, more intervention will continue to postpone the inevitable. And the question investors aren't asking themselves right now, seeing this and rallying everything, okay, at what point does the music stop? And at what point do these guys run out of tricks or something breaks? Because the math doesn't work. You cannot forever take care of all of these terrible debt issues and currency issues by adding more of the same and thinking you're going to get by with it indefinitely.
It was interesting. There was a meeting, and somebody showed Besson's notepad and it had to-do
Yeah.
list, and I don't think it was AI, and it said buy in. And I was like, is that,
Oh, he admitted it.
yeah, is that
Yeah.
him or the Treasury or both? And I was just like, wow, this is what a crazy world we live in, that this is just, they're not even trying to hide it anymore.
No, they're not. I mean, and he admitted in an interview since then that, yep, he wrote this in big letters to make sure people understood what was coming. It's like the president now, you pay him enough money, you'll get a little bit even more advanced notice of his true social posts so you can punt one way or the other in the markets. I mean, that's all that's left, seemingly or predominantly so, is more financial alchemy, more speculation in the markets, because it feeds on itself and you can't take it away anymore. And so, to my way of looking at it, Kevin, the more we do this, the bigger the bust is going to be. And you let off initially asking about interest rates. Well, look at what interest rates did when all of a sudden a week ago, Kevin Warsh was very adamant and still was trying to be that, oh, our 2% inflation target, we're tired of it. This committee is going to we're resolute to get to that. And all of this high sounding stuff, yet they didn't raise interest rates and they gave all kinds of mealy mouthed reasons why, well, maybe I'll let the market do it. I don't think you want to be in that place. I don't know if you saw this post I put out a few days ago, but years ago, Fram oil filters, they had this iconic ad on television where it shows an auto mechanic. He's underneath the car and he's trying to impart the lesson that if you don't do regular oil changes in your car, and if especially you don't use the best oil filter on the market, meaning Fram oil filters, of course, down the road you're facing problems by being penny wise today, pound foolish long term. And so he basically said, you pay me now or pay me later. If you're not going to spend a few dollars for the best oil filter now, maybe you're going to have an engine rebuild somewheres down the road. And that's what Kevin Warsh needs to get through his head really fast for the next episode of the bond market vigilantes trying to call him on the carpet comes. Because if you don't raise rates now, you're going to repeat the same mistake the Fed did in the 70s, which is exactly what the Fed is doing right now and not taking this resurgence in inflation this year seriously. And if they get dragged into doing it by the bond market, because long-term yields exploded higher last week after his meeting. They've softened since then, but there's no question the trend is still upward. Later, they're going to have to raise rates more and maybe against their will to keep the long end of the market in check. So I think it's really Warsh is playing with fire. Last week, as I put it, was his mulligan. Okay. You get one mulligan, well, the way I play golf, it should be every hole, but you get one mulligan every 9 holes, the way I play golf. And he just took his last week because almost unanimously, the financial press really had some major questions coming away from that press conference. Is this guy really bluffing? Is he scared to raise interest rates? Does he not intend to raise interest rates? If he leaves up to the bond market, he's in a lot of trouble.
I was waiting for the pal transitory phrase to
Right.
slip out
He's not that
just out of
stupid yet.
but just out of habit, like I feel like that was in every press conference during
Yeah.
that COVID time frame. So I was waiting for that to go off and everybody lose their mind. But I think it's interesting how he's trying to be less transparent because he wants to create less volatility and have less meetings. And I'm like, I don't know if that's going to have the effect that he wants it to, but also I feel like there's too many media types who need those, however many months or however many weeks are between meetings, like they need those meetings to have a soundbite. So I'm curious if he's actually going to stick to that because I feel like the pressure is going to be the other way.
When I started doing this 45 years ago, whatever it's been now, there were no such meetings as this. Paul Volcker finally in the early 80s instituted the modern day schedule of Fed meetings, FOMC meetings every 6 weeks,
Okay.
approximately. Before that, Paul Volcker's idea of letting the press know what he's doing is in the, first thing in the morning, attention. The Federal Open Market Committee decided last night to raise a discount rate by this, raise a federal funds rate by that. If you don't like it, too bad. Have a nice day. That was your Fed meeting, okay? And one of the things, and I like this about Warsh, and I agree with it, the Fed has become too big a part of everything. We shouldn't all be obsessing over every jot and tittle and syllable out of a Fed head or whether it's the chairman or anybody else at the central bank. But that's the world in which we live because the Fed itself, because of the very nature of the way our debt system works, you need more and more debt. You need more and more financialization as time goes on. You need more and more gimmicks to keep the whole house of cards from imploding. And that's why the Fed has become so important. So, regrettably, for everybody's sake, including his own, Kevin Warsh, who says he's a practical monetarist in kind of a traditional sense, as far as Fed chairs go. And I agree with that. But he's coming into the position at a time when, before the midterms, we will officially hit $40 trillion of acknowledged federal debt. Interest costs continue to rise. Now they're going to be, I think, even by the end of this fiscal year, not including whatever additional supplemental spending because of the Iran war, the interest will be the biggest line item on the budget, even ahead of the defense/war department. So that's a position he comes in. And what he needs to understand, and what I think a lot of people in the press who are pining for ever more easy money need to understand is the same lesson as that Fram oil filter. We can pay now or pay later. He can raise short-term rates now and make the whole world understand that, yes, at the expense of maybe a overdue recession, an overdue pullback in the markets, we are going to get inflation under control. If he did that credibly, guess what happens to long-term borrowing costs? They come down. It shocks me the number of people out there who get a lot of money, who get on CNBC and Fox. Oh, well, the Fed can't raise interest rates because the government's borrowing costs are what? In the long run, no, they won't. They'd come down, all
But
else being equal.
I feel like the government isn't all on the same. Like, I feel like if this is a football team, they huddle up, and I feel like they're either not telling each other the same play in the huddle because I feel like Besson comes out, and I've seen, more government people lately talking about tariffs and a return to Hamiltonian economics where we want to build stuff, we want to protect our industry,
Yeah,
which okay, probably a good idea,
yeah,
it'll help, reinstitute maybe the middle class that got gutted, like the whole Rust Belt, that whole area that lost everything to
right.
China. But if we're going to do that, that's going to be inflationary. So how do you help Warsh fight inflation if you're going to do that? And how do you tell him to cut rates if you're going to do that and cause inflation? Like I feel like those two don't necessarily mesh together, and I don't know if I trust the government to be able to figure it out to thread that needle to
Oh.
make it work.
I don't either. Look, I have said from day one, and you and I have had this conversation that I thought Warsh, and I still tend to lean this direction, no matter the bad start that he's gotten off to, that we were going to see two acts of Kevin Warsh. Number one is come in, administer the harsh medicine, at least get the markets to realize that he is not going to allow open-ended inflation and open-ended dollar devaluation like his predecessor did. Okay. He has carped endlessly about the Fed is 63, 64 months into a regimen where we're well above the 2% target. If the market's going to take us seriously, we've got to have a game plan and get back to that. So do that. get inflation credibly trending downward, all right. And then you can roll out things. And this is interesting what's going on in Japan right now. We're only starting to see the beginning of this. In Japan, they're now going to use cryptocurrencies and other assets as part of a remonetization scheme to try and shore up the yen. This is coming for the US as well, Kevin. Don't forget that Kevin Warsh, one of the biggest reasons he got selected to be their chairman, and Donald Trump would have, selected Snoopy the Beagle if he'd been told to do it by Scott Bessent. But Bessent wanted him in there because Kevin Warsh is one of the architects of the whole stablecoin regimen. They have a game plan up their sleeve, which we're going to hear more about as early as the end of this month at the Fed meeting in Wyoming, because that's the topic of the meeting, are these different newfangled kind of payment systems and stuff. This is the latest extend and pretend way they're going to come up with to use financial alchemy to enable debt to continue to grow without blowing everything up. So what Bessent has done now is to kind of force Warsh into basically going against what Warsh said, because one of the things I loved about Warsh's early comments is he said in his first meeting, inflation is a choice. We had Jerome Powell meeting after meeting kind of acting like, John Belushi and the Blues Brothers, when he's Jake Blues and he's in that culvert underground and Carrie Fisher's got the gun on him, wanting to know why he stood her up at the altar, and he's got every reason except the right one. I lied and I didn't come to the wedding. But no, he's got a flat tire. His tux was at the casino, at the cleaners, all these other different kind of reasons. That's what we heard from Powell, right? And Warsh said Powell lied without using that term, because that was a choice the Fed made to print all of this money in the wake of COVID, especially because he properly channeled, the late Milton Friedman saying inflation is always and everywhere a monetary phenomenon. So, all right, Mr. Warsh, if you really believe that, you're going to resist Scott Bessent trying to get you to do more of it, at least right now. You're going to stick to your guns and say, okay, we've got the whole world, not just the US, has got to rein in all of this unchecked currency creation. Or let's just be honest and say, okay, let's just start manufacturing more wheelbarrows because that's where we're going if we keep printing all this money.
What do you think the outlet will be? Because I've seen some foreign countries and some high up people in overseas say the stablecoin stuff is just nonsense and it's just another made up creation for the US to keep printing money and keep doing debt. So do you think, and I don't know enough about it, but they're probably not 100% wrong, but do you think the outlet will be stable coins, or do you think it'll be gold having to get revalued higher to kind of make the math work?
Let me talk about gold first, because I know there is a lot of stuff out. You may have seen some of it. The 4th of July, Donald Trump was going to come out with this edict that was going to save America, the 250th anniversary of the US, and we're going to revalue gold and all this other kind of stuff. If you marked gold to market today, you know what you'd accomplish? About 6 months worth of the deficit. You wouldn't even take care of the deficit for a year, let alone put a dent. You would have to reprice gold into the many tens of thousands of dollars to be meaningful. So I don't see that as part of an option at all. Well, I'll
That's
tell you
where
what
the
I
tariffs come in too, though, right? Because we're going to bring those back. He's trying that again. So if you have the tariffs and the revalued gold, now we're going to be rich again, right?
pie in the sky. I mean, it sounds nice. And if you were starting some of this stuff from a position of not already having 40 trillion in debt, yeah, it'd probably work. Okay. But the other part of that, not to get too far afield here, Kevin, Hamiltonian economics and in principle, I like more of it than I dislike. Okay. Why are we doing so little as a country, public policy wise, to truly bring back industry, the middle class, energy, mining, all the different things we need to meet all of these goals that the president has articulated? Okay. If we were spending 1% of the money and public policy attention on that we are on this war that he decided to get us into in Iran, I'd feel a little bit better about things. But we're not. And so, like last week, when the president came out and it was executive order, we're going to discourage exports of critical minerals that we need. Really? Like what? We're actually producing more than we need? No, we're not. But this is more the flim flam. They brag about record oil exports, Well, how is it that we got so much oil to burn that we got record oil exports, and yet the Strategic Petroleum Reserve is at multi-decade lows? So, I mean, we got inmates running the asylum, not only monetary wise but policy wise, and this is why we've got such a mess, Kevin. I think that, as you said a minute ago, you got all these different people running the show, and one's doing this, one's doing that. They're not all on the same page. We do not have a national industrial policy or emergency type of a policy that we need to have for our middle class and energy and mining and so forth. It's all sound bites. It's all things that Fox News will regurgitate dutifully, for example, and say, "Oh, goody, the president's going to make us energy independent." I don't call a strategic reserve at 40 plus year lows. And unanimously, the execs of energy companies saying that they're not going to put new money into the ground because things are too uncertain. I don't call that energy independence.
No, and that's where I worry about AI and how disruptive it is. And AI growth has been exponential, and we can't seem to, like, as a country, as a legislative body, as a government, like, we can't, I don't think we can adapt quick enough to
No.
change to it. And that's what worries me of with the strategic petroleum reserve so low, with energy prices so high, with AI coming for white collar jobs now. Like there's just so many disruptors out there that it worries me. Like, I think the market can continue to go higher. And I don't know. I just worry about what this plan is between now and midterms. Because if they lose the House, and I'm not a political expert, but if they lose one of those houses and now you have even more gridlock than you had before, and Trump just tries to do emergency orders or presidential orders or however he's been doing that stuff's just going to be tied up in court, and you're not going to have any resolution to anything. You're not going to have any compromises to anything. And where does that leave the average American a year from now? That's my
Well,
worry.
not in a good place, and I agree that, and I frankly think that if the political fate of President Trump is the same in this midterm as it is, 20 of the last 22 midterm elections, the party of the president loses, and I don't see that changing appreciably, especially with opinion polls so much against this war, and a lot of the president's core supporters who helped him get into that office a second time, they've all rebelled against the Iran war and related things to that. So, look, I think that the president, even now, the best case the Republicans have are the Democrats because they can't seem to get a unified message except Orange Man Bad, which has been their message all along, it seems, with so many of them. They don't really have a credible program. I mean, there's so few places where the Democrat Party is behind anybody but the farthest left whack jobs, it seems. And so maybe the Republicans dodge history and dodge fate. I don't know. But, I think that things are going to change very abruptly. All of this attitude right now that everybody's bulletproof, you can keep chasing AI stocks higher, you can keep chasing everything higher. That's going to come to a screeching halt if all of a sudden the president halfway into his second term is a lame duck already and is going to constantly for 2 more years if he's in there that long, is fighting investigations and impeachments and all this kind of thing. But I wanted to pick up one more thing you said though, Kevin, about AI. You know Jim Chanos, or you know who he is, of course, and he's one of a few people recently who has pointed out what I firmly believe, and this goes back to my comment earlier about Scott Bessent and others who are just frantic trying to continue to use duct tape and twine and whatever to keep everything together, all of these leaks in this monstrous global debt and currency edifice. Okay. AI and the kind of money that has brought in, the debt, the off the books debt, even the Financial Times several days ago looked at the top 5 tech companies. Off the books, they have $1.6 trillion in debt related to AI. Okay. You can go back to the early 2000s with the mortgage and real estate bubbles that did not spring up because of any demand on Main Street. Okay, Wall Street figured out that they could make a lot of money force feeding all of this cheap credit. They were the one, Joe Sixpack didn't get out of bed on a particular morning and say, let's go out and buy more house than we can afford. We'll use a zero interest mortgage and or no interest only mortgage for the first 5 years or whatever. It was Wall Street and bankers literally knocking on his door, telling him he's an idiot and doesn't understand modern money mechanics and how he can buy more of a house than he needs because we've got this magic now. Well, that blew up. Several years later, Wall Street does the same thing, but now to the energy companies. And you had all of this fantastic new technology with being able to extract oil from shale. And so that was force fed. What did that do? Another thing that, apart from any need that the economy actually had for this, you increased too dramatically production and production capacity. What did that do? Caused prices to crash for a while, bankrupted a bunch of energy companies. Both of those pale in comparison to the amount of money and debt represented now with this whole AI trade. And I am 110% convinced it's going to end the same way. And as Chanos and others have said, the technology is legitimate in some form. It will continue, but the valuations today and a lot of the companies involved and the debt involved will vaporize just as the shale boom, just as the real estate and mortgage boom.
I worry. I've seen OpenAI about the government taking stakes in it. And to me, that's not bullish. That's a smoke alarm to me that they need a bailout. And this is the American taxpayer being exit liquidity because they can't figure it out. And that's the more I see the government taking or talking about taking stakes in that, the less bullish I get with the AI trade in the short term, because I just think that's not a signal of strength from those companies. If they're pitching it that way, it means they're really short on money, or the cost of borrowing money is getting so expensive that they can't justify it.
Well, exactly. And besides all of that, and making the point that I just did on the mortgage and shale thing and the corollary now with AI, it's also too darn much Big Brother, if you ask me. It's
Well,
it's astonishing that when you look at the volume, and this is another thing, Kevin, really. I mean, if you look at all, I mean, the president loves to brag about how many gazillion dollars worth of investment promises he's had, the majority of it over AI, but not just that, some other things that are legitimate. Okay. It's physically impossible, mathematically impossible to build all the things that have been promised. You don't have the raw materials. You don't have the people with the skills. You don't have the energy. None of these things are in place. And yet all of these promises and plans and even some investment and a lot of debt are predicated on somehow or other, all these nuclear power plants are going to magically appear in the next few years. Forget about the fact that the uranium mines, the copper mines, all the other things take years to decades to permit in this country. We don't have enough of any of that stuff. So it's remarkable and I've seen this pointed out many times. We were all being told that climate change was an existential crisis. We got to stop doing this and doing that, and our demands on energy. If all of these things were able to be followed through on, AI and data centers would double energy consumption in the next 30 years.
I think
Where's
it's
it
going
coming
to double
from?
by 2030. I saw some stats.
Maybe even by then. Where's it coming from? It's not there, and it's not going to be there.
Yeah, I don't know, but I think we should wrap it up there.
Okay.
Where could our listeners find more about the National Investor?
Well, simply go to nationalinvestor.com and follow the yellow brick road. You can sign up for our free mailing list there. There's information how to become a member and get all of my specific investment allocation, ETF, and stock recommendations. Lots of stuff there. And all of our social media links are there as well. So easy, just nationalinvestor.com.
And you send something out every weekend, right? A written report.
Oh, at least. I mean,
Yep.
typically my broad list gets something at least once a week. Sometimes in between that, our members will get the missives besides a regular newsletter that goes out once a month on average. But in between newsletters too, I send out things if there's if we need to zig or zag or change our allocation. I'm not a day trader. I don't advocate it, so it's not like people are getting something every single day saying do this or buy this option or something like that. I'm for people who like things a little bit easier, but also want to have a good foundation and game plan behind what they do.
Well, awesome. Thanks again so much for coming on. That's
My
it for
pleasure.
today. If you're following us on YouTube, please hit the subscribe button so you don't miss our next interview. Thanks for joining us.